In the closing hours of trading in June 2026, the trajectory of global capital was violently halted and reversed. Major equities staged an immense late-day relief rally. The S&P 500 jumped 1.3%, the Dow added over 800 points, and the borrowing cost-sensitive Russell 2000 surged 2.6%. The trigger for this reallocation was a statement from the Oval Office. President Trump announced that the United States had reached a framework agreement with Iran, projecting a signed deal within days. This afternoon euphoria masked deep distress from earlier in the session. That morning, markets were smothered by a 4.2% U.S. Consumer Price Index print for May, a three-year high driven by energy shortages. The equity surge relies on a single assumption, that the Strait of Hormuz, the world's most critical maritime energy choke point, will immediately return to its pre-war capacity of 20 million barrels a day. Financial markets are aggressively pricing in a geopolitical de-escalation, but looking strictly at the tape ignores the broken physical supply chains hidden beneath it. The U.S. Iran agreement is strictly a framework. It leaves core strategic disputes, including nuclear enrichment and sanctions relief, unresolved, requiring a highly fragile 30 to 60-day transitional period for negotiation. Even if the ink dries, political decrees cannot instantly clear minefields, dismantle naval blockades, or reverse the high insurance premiums currently paralyzing commercial shipping in the Persian Gulf. This framework forces a reassessment of the long-term reliance on centralized, hyper-efficient trade routes through single points of failure. Bypassing these bottlenecks demands extensive capital. This points toward a structural increase in the global inflation floor, challenging the return of ultra-low interest rates. Corporate allocators expecting a return to pre-2026 operational metrics will be caught off guard. Surviving the next decade requires adapting to a landscape of sustained structural friction. Following the framework announcement, futures traders stripped the geopolitical risk premium out of the energy complex. This comparative data table shows the exact contraction in early Asia trading. July WTI crude fell 1.65% to $86.26, while August Brent crude dropped 1.55% to $88.98. That paper decline contradicts the physical reality on the water. Restoring maritime throughput requires comprehensive demining operations and complex renegotiations with global shipping conglomerates, a process measured in months, not days. Furthermore, the massive physical export infrastructure located in the Gulf remains under heavy military constraint, highly vulnerable to any breakdown in the 60-day negotiation window. This line chart illustrates extreme market backwardation. Because physical barrels are constrained by the ongoing maritime logjam, crude for immediate delivery commands a significant premium over the futures curve. Procurement teams lured into complacency by a drop in futures contracts will be penalized by the sticky, elevated costs of actual physical delivery. This energy dislocation severely complicates the mandate of global central banks, injecting a volatile exogenous variable into their inflation models. This flowchart maps the Hormuz supply-side shock cascading through manufacturing, generating the 4.2% inflation print. This creates the classic Fed trap. Raising rates risks a severe recession, while cutting them risks unmooring long-term inflation expectations entirely. The diplomatic breakthrough provided the Federal Reserve a vital off-ramp. By removing the primary engine of supply-side inflation, traders recalibrated their expectations, allowing the 10-year Treasury yield to immediately ease. The European Central Bank lacked the domestic energy buffers enjoyed by the United States. They were forced into aggressive action, hiking interest rates into a fragile economy to prevent the importation of inflation through a weakening currency. The framework agreement averts an immediate stagflationary spiral. However, the structural damage inflicted on global supply chains suggests that base interest rates will remain elevated for the foreseeable future. Beneath the surface of the broader equity rally, the restrictive capital environment is forcing a reevaluation of the artificial intelligence sector. Institutional investors are now exhibiting severe CapEx fatigue. They are no longer rewarding the accumulation of infrastructure for its own sake. They demand clear, immediate paths to profitability. This diverging bar chart contrasts two distinct realities. Despite strong profits, software giant Oracle suffered an 11% stock plunge after announcing a $40 billion debt raise to fund AI infrastructure. Meanwhile, semiconductor firm Marvell Technology surged 6.3%. The market is aggressively discounting software firms taking on massive high-yield debt while maintaining a speculative premium on the companies providing the physical hardware architecture. As the cost of borrowing rises and liquidity tightens, the market is no longer deep enough to absorb every major venture. This environment makes the impending SpaceX IPO, fixed at $135 per share, a significant drain on available market capital. Anticipation of this mega IPO acts as a cash magnet. Portfolio managers are liquidating over-leveraged equities and speculative assets to clear capital for the aerospace giant. Capital is no longer free. Moving forward, technology valuations will be governed by strict operational efficiency and the competition for scarce institutional liquidity. The most definitive proof of this new economic reality is found by looking away from the paper markets and examining the structural changes occurring in the Asian physical economy. Japan is a resource-poor nation that historically relied on the Middle East for over 90% of its crude oil imports. The Hormuz blockade exposed this as an existential vulnerability. This supply chain map demonstrates the response. The Takaichi administration mandated 100% of crude imports be sourced from non-Hormuz routes. Oil is now routed from the Gulf of Mexico, the Atlantic Basin, and Africa, entirely bypassing the Middle East. This resilience exacts a permanent financial toll. The cross-ocean logistics are more expensive, and Japanese refineries must execute hardware retrofits to process these non-traditional crude grades. By ensuring its industrial survival, Japan established a new global precedent. De-risking physical supply chains increases the baseline cost of industrial production. This three-pillar dashboard outlines the evolving macroeconomic baseline. The trade-off between efficiency and security has shifted, replaced by balkanized supply chains, an elevated inflation floor, and scarce capital allocation. Because of this structural friction, returning to a reliable the immediate market rally is a reaction to an averted disaster, but long-term corporate viability now depends entirely on recognizing and adapting to a structurally higher cost of doing business.